When a portfolio company announces its Series B, finance teams often scramble to answer a deceptively simple question. What are our rights, and how does this round affect our ownership? Across a 40-company portfolio, with varying investment instruments, stages, and term sheet provisions, tracking pro rata rights and anti-dilution protections becomes a persistent operational challenge. What makes this tracking so difficult? The complexity stems from several sources that compound across a large portfolio. Varying instruments, safes, convertible notes, and priced equity rounds each carry different right structures. Multiple rounds per company. A seed investment may have different provisions than a follow-on Series A check into the same company. Time-sensitive decisions. Pro rata rights typically come with exercise windows of 10 to 30 days. Document fragmentation. Rights may be embedded in term sheets, investor rights agreements, or side letters. Consider a 75 mailers early-stage fund with 40 portfolio companies. At any given time, several companies are in active fundraising discussions. Without centralized tracking, finance teams risk missing pro rata exercise windows or miscalculating ownership positions when anti-dilution provisions trigger. How do pro rata rights work in practice? Pro rata rights, from the Latin meaning in proportion, grant investors the option, but not the obligation, to participate in future rounds to maintain their ownership percentage. These rights are simply meant to guarantee an investor an allocation if they would like to invest it. The calculation varies by provision type. Pro rata structure. How it works. Percentage-based, investor maintains exact ownership. Percentage dollar for dollar. Investor can invest up to their original check size. Fixed sum, pre-agreed dollar amount, regardless of ownership. Percentage-based provisions are most common in institutional deals, though tracking them requires current cap table data from each portfolio company, data that isn't always readily available. What triggers anti-dilution adjustments? Anti-dilution provisions activate during down rounds when a company raises capital at a valuation lower than the previous round. These provisions protect investors by adjusting the price at which preferred stock converts into common stock. Two mechanisms dominate. Broad-based weighted average, the most common approach, used in roughly 60% of VC transactions. It strikes a balance by spreading the dilution based on the price and quantity of new shares issued. The calculation considers total outstanding shares, making it more founder-friendly. Full ratchet, rarely used but highly protective for investors. Series A investors have the right to convert their shares at the new lower price. This mechanism effectively shifts dilution entirely to common shareholders. For finance teams, the challenge lies in running these calculations accurately across multiple portfolio companies simultaneously, each with its own cap table structure and historical round data. What systems support this tracking? Many funds still rely on spreadsheets, but scaling to 40-plus companies typically requires more robust infrastructure. Cap table platforms, Rata, Pulley, Captable.io, centralize ownership data, and can flag upcoming financing events. Portfolio management systems, Vestberry, Totem VC, Diligent Equity, integrate cap table data with fund-level reporting. Document management remains essential for maintaining accessible term sheets and side letters. Tracking these rights across dozens of portfolio companies, each with different financing histories, can be a significant operational burden. What should a tracking framework include? Effective tracking typically covers rights inventory, which companies carry pro rata rights, and what calculation method applies anti-dilution provisions, mechanism type and trigger thresholds for each investment, exercise windows, calendar integration for upcoming deadlines, current cap tables, regular updates from portfolio companies, ideally quarterly reserve allocation, follow-on capital set aside for pro rata participation. Some funds establish internal policies around pro rata exercise, committing to participate in every Series A regardless of performance, for example, which simplifies decision-making but requires disciplined capital reserves.